Thank you. This is Hatem Ben-Ameur speaking to you today. This is a joint work with my ex-PhD students. Malek and Dream are now assistant professor in Cairo, Egypt. Tarek is associate professor in Sfax, Tunisia. First of all, I'd like to thank our head at GERAD, Olivier, for giving me this opportunity to share and defend my ongoing research piece entitled Quasi-maximum likelihood for estimating structural models. So the outline of the presentation is as follows. I am going to introduce the subject and essentially to motivate the research question, present the model, and go directly to express the likelihood function. But I told myself, because of the audience is not necessarily specialist in financial engineering at GERAD, maybe I can give you some insights on the design of the model, the resolution step, and the estimation step. And of course, the focus is being on the estimation step, the main topic of my talk today. I have a case study, Pharma, which is a drugstore company that went bankrupt in the past, to show that what is built here is practical, can have empirical and numerical impact. Some extensions to end my presentation. Okay, so the main objective of the structural model is all in all to evaluate credit corporate bond portfolios. And once this evaluation step is done, we come to compute main credit risk indicators, such as required yields, credit spreads, default probabilities, conditional and non-conditional, distances to default, among other main parameters, indicators for credit risk analysis. Okay. The structural model I am discussing today is called an extended structural model in the sense that it is realistic, includes several extensions with respect to fundamental papers in the literature, and thus cannot be solved in closed form, neither estimated in closed form. So it has to be approximated in some way. Here we use stochastic dynamic programming for the resolution step. I will come back to this issue later on. Okay, but for the estimation step, mainly we combine in between stochastic dynamic programming and the maximum likelihood principle to estimate our extended structural model. Last week, I went and visited the website of the Bank of International Settlements to pick some statistics. And telling us that the total outstanding amount of debt securities issued the statistic holds for the end of June 2021. It's about 50 trillion US dollars, 7 of which are issued by corporations. So we are speaking here about a lot of money, to say that the subject is of great importance for the financial industry. Okay, so let's go back to the basic starting point and explain what is going on here. I'm trying to put everything under paint so I can write quite easily and indicate the main points quite easily. Okay, let us start for a balance sheet equality of a traded company. Mainly, we have, give me a second to be able to do the job. Okay, we have at the right-hand side the resources of the companies. These resources are internal, brought by the owners, called here equity and indicated by capital E. The resources can be external, brought by investors, external investors, indicated here by capital D. This is the corporate debt portfolio. And in the left-hand side, we have the assets. In fact, internal resources and external resources are pulled together to buy the assets, lands, factories, machines, equipments, cars, and so on and so forth. And what remains is cash. Please, I'd like to ask you if you have, we have a visual on my power, on my paint.
Yes, we see it very well.
Thank you a lot to give me this information. So back to the talk, and in this situation, in all times and all states of nature, whether it is shiny or rainy, we have a balance sheet equality telling us that the present value of the firm's assets is equal to the firm's debt value plus the firm's equity value, all time, all states of nature. Okay, so starting from this balance sheet equality, we need now to put some structure to make this mini model, the theoretical model, trustful. We need minimum information, minimum good properties, so that signals coming from this theoretical market become trustful. And the main property here that we can obtain, but minimum assumption, is the absence of arbitrage. All in all, we are looking for a theoretical market that does not allow arbitrage, meaning that any investor in this mini market cannot make money without taking risk. And for our market to verify these good properties, we have sufficient conditions in the literature in financial economics stating that it suffices for the state variable, capital A, the firm's asset value to be Markov and to verify a certain martingale property, which is quite easy to verify. I give examples. The log normal process of Black and Scholes 73 is Markov, continuous in time, continuous in the state variable, and verifies the martingale property, can be assumed here also as it was done by Merton 74. I will come to the fundamentals. We have several Markov processes in the literature that are Markov and verify the martingale property, which result in the no arbitrage principle, which result in the no arbitrage property, such as some jump diffusions with symmetrical jumps up and down, asymmetrical jumps up and down, the variance gamma process, the Garch, some Garch processes, some continuous time and continuous state stochastic volatility processes, to say that this issue is well discussed in mathematical finance, and we have quite flexible selection depending on the situation, depending on the economic conditions. Okay, good. Let us assume that our market is does not allow arbitrage, under these conditions, we can evaluate corporate securities using the fundamental theorem, stating that any financial security can be evaluated as an expectation of its future potentialities discounted back at the present date, and this expectation is conditional on the information available at the current date, but not, of course, on the full history of the trajectory of the state variable, because the state variable is Markov. Okay, I will go later on to discuss this issue, but let us focus on the mechanics, the main mechanics to evaluate corporate securities within this particular setting. Okay, now, once the fundamental theorem is active, we'll try to express the equity as a function of the fundamental asset, the underlying asset, and the debt as another function of the state variable. Okay, just a remark before going into the evaluation principle in that particular setting. In fact, recall that the main objective of the structural model is to evaluate debt securities. This is a main issue because fundamentally debt markets are totally or partially illiquid. So we need trustful signals coming from the market, which is not the case here because the market is completely illiquid. But we have in exchange accounting values that come from time to time on a regular basis. Here in North America, we have access to accounting values each quarterly, which is not as bad. But accounting values, unfortunately, are not so sensitive to changes in the credit quality of the company. So accounting values of debt securities are not adjusted when the credit quality of the company improves or deteriorates. However, new accounting rules are pushing in the back the accounting industry to swap, exchange accounting values for theoretical values whenever market values are not available. I see on that a very interesting and a very important issue for us, because the accounting industry has started to hire from our MSc program in financial engineering because our MSc students are specialists on this evaluation, theoretical evaluation process. I would say, thank God, this is a good opportunity for us. Okay, and we'll come back and explain how the evaluation process is going on in this particular setting. First of all, given the structure of the debt security, we will interpret the firm's equity as a function of the firm's asset. In finance, we say as an option on the underlying firm's assets. We can say also the equity is a financial derivative on the firm's assets. As well, we can express the debt as a function of the firm's assets. Now, this function, of course, will depend on the assumptions we put on the firm's debt portfolio. For example, for Merton 74, as maybe you know, Merton opens the door to this mega construction called the structural model. Merton assumes that the firm's debt portfolio is made of a unique, a sole, pure debt, a zero coupon debt that pays no coupon, but a principal amount at a given maturity, future maturity date. Under this assumption, Merton assumes a very simple structure for the debt security and proves that the firm's equity can be interpreted as a European call option on the firm's assets. Black and Cox assumes a portfolio for the debt corporate security made of two pure bonds, one senior and one junior, and again interprets the equity as a European call option, as it is the case in Merton. Geski 77 comes with a big extension and assumes that the debt is made of a coupon bond that pays interest on a regular basis and the principal amount at a certain maturity date. Leland 94 assumes a console debt. It's a sort of perpetuity that pays coupons or interest in continuous time. While Brockman and Tortel 2003 assumes comes with an exogenous barrier for the firm's assets. And the idea here is to protect bondholders in the following way. When the firm's asset value comes below this barrier, the company is liquidated. Bondholders are paid first, and normally nothing remains for equity holders. Equity holders, by the way, are supposed to be very diversified. So when the company goes bankrupt, it's not really a very big issue for them. Now, the fundamental question here, what happens when we relax all these assumptions and make the debt portfolio extremely flexible, as it is observed in real life activity. So we, in this paper, our model accommodates the true coupon capital payment schedule as it is observed in real life activity, which is an important extension in this setting. So now, recall, we don't have trustful market information for the debt. Accounting values suffer from a very weak, from a strong issue because the accounting industry needs signatures, contracts to modify, to adjust values in the balance sheet. So we come to theoretical values. And this is a way to evaluate the debt. But still, we need a basic information to calibrate, to estimate, to adjust the model to what is observed in real life activities. And here, the basic information is the stock market, in which we trust, because it's in general liquid, sufficiently liquid for traded companies. So in all cases, whether the model is simple, solved in closed form, or much more complex and approximated in some way, the equity, the theoretical equity value is matched with the market cap. The market cap, which is the sum of all stock prices negotiated in the stock market. Recall that from this assumption, we are saying that we trust the stock market, so that whatever we go for the resolution, whatever we do for the resolution step and the estimation step, the theoretical value of the firm's equity is matched, perfectly matched to the market cap. Okay, now we have two main information here. The right equity value is here, it's the market cap, and the equity value function is equal to a function of the state variable of the state process, the firm's asset value. So the first step is to go the reverse side. So to start from the stock market, catch the theoretical value of equity and go and evaluate the firm's asset by inverting the function G. Somewhat, the function G may be quite complex to invert. If it is the case, we can go and invert it numerically. Then via the balance sheet equality or via the function H, we go from capital A to capital D and evaluate the corporate debt security. This is always the case, whether the model is solved in closed form or approximated in some way. This mechanics is always here. I hope it's quite clear for the audience. Tell me yes, please, so that we can go forward.
Yes.
Thank you.
Yes.
1 time, 2 times. We are not, the audience is limited, but these 2 yes answers give me confidence to go forward. Next, in terms of design, our model accommodates, in fact, all Markov processes that verify the martingale property. This is a big extension and interesting extension for the financial industry because depending on the economic context and financial market movements, we can go for one dynamic or another. The model is very flexible. Also, our model accommodates any arbitrary interest and capital payment schedules, which is a good step in the right direction because we are telling here we can capture the schedule payment as it is in real life activities. And the same model accommodates several seniority classes. Here we go for 2 seniority classes, senior and junior, but we can split the quality of bondholders or the priority of bondholders under liquidation in as many classes are wished. An ongoing research project. In an ongoing research project, I am now working on options embedded in corporate bonds, which are features included in corporate bonds and live within corporate bonds, such as the call option, the put option, the conversion option, the extension option, the exchange options, which all in all give privilege to the bond issuer, here the company, or the bond holder, here investors. Recall what I called about external resources of the company. And of course, these options, these features have a great impact on the evaluation process and in the level of the firm's bond corporate debt values. In addition, we are able to augment the basic balance sheet equality to include several intangible assets that are not negotiated in the market, but they are here, like tax benefits, reorganization costs, illiquidity costs, bankruptcy costs, among others. These are interesting extensions that may explain many stilised facts reported in the literature, such as the credit spread puzzle, for example. And at the end, we come with a new estimation step based on maximum likelihood. In fact, that combines maximum likelihood and stochastic dynamic programming, but we are extending this estimation step in an ongoing other research project to estimate the structural model based on information coming not from the stock market, but on other markets that are much more sensitive to credit risk changes for a company. For example, I cite CDS markets, equity options markets, among others, to say that around this construction, there are several ways to propose extensions and to build new research pieces hopefully, I hope, good enough to be well published in the future. Okay, what else? I'd like to say something about the evaluation process before switching and document the estimation, the model estimation step. Okay, so the fundamental theorem of asset pricing in no arbitrage market says that we can evaluate any financial asset as an expectation of its future potentialities, here resumed by the value function at the next evaluation date. By the way, in our context, the evaluation dates are payment dates, because in between two payment dates, nothing happens, and there is no possibility that the company defaults. So we can go here backwards step by step from and evaluate the corporate security, any corporate security at each observation date, here each payment date. So as you see, the present value at the current date Tn, which depend on the level of the state process, lowercase a. It's an expectation of the future potentialities promised by this asset, resumed here by the value function at the next evaluation date. And of course, from the perspective of an investor at time Tn, the state process at time Tn plus 1 is random, completely random. Once the uppercase letter I use here to indicate the firm's asset value. This value is discounted back from time Tn plus 1 to time Tn. And of course, this expectation is computed conditional on the information available to the investor at time Tn, but not on the full history of the trajectory of the state process, because mostly the state process is assumed to be Markov. So we have here mainly the two optimality conditions of Bellman are verified. First of all, we do know all value functions in this mini market, theoretical market, at least at the debt maturity. So the debt maturity will be our starting point to launch our dynamic program and evaluate all corporate securities. The second optimality condition says, in fact, any value function is a function of the actual position of the system and the future evolution of the system, but does not depend on its past trajectory. This is the case in a mathematical point of view, and in a probabilistic point of view. This conditional expectation depends only on the current level of the state process, but not on its past trajectory. Thus, we can interpret the evaluation process as an optimal Markov decision process, apply stochastic dynamic programming here, and come with a resolution step, which combines between approximations and interpolation at each evaluation step to solve the problem. Mainly, you understand that the value function at the next evaluation step with respect to an investor at time Tn is itself an expectation. Inside the expectation, we have the next value function at time t(n plus 2, which itself is an expectation of the future potentialities of the contracts from the perspective of an investor at time t(n plus 2, resumed in the value function at time t(n plus 3, and so on and so forth. To say that, all in all, this expectation is in fact a multi-dimensional integral that cannot be computed in closed form and has to be approximated in some way at each step of the recursion and for all levels of the state process, of the state variable at the evaluation date. The main idea here is to put a head on the value function inside the expectation, to put a head on the integrand, so that this expectation becomes feasible. And we come to an approximation at the earlier evaluation date. Several heads work, such as piecewise constant approximations, piecewise linear approximations, piecewise quadratic approximation, all in all, finite elements based approximation. But other approximation can be used, such as spectral approximation proposed by Michel here with us today, Fourier approximation, somewhat difficult to implement and maybe somewhat less efficient, but still feasible. I don't know, possibly neural networks may work in this context for multi-dimensional structural models, to say that these mechanics is quite general, and the topics still includes several open research questions, to say that it's interesting to be in there. Good. Now, the evaluation process has been done. This process is explained in detail in several GERAD reports. Some of them were well published in the European Journal of Operational Research, Quantitative Finance, Journal of Finance and Futures Markets. Some of them are submitted to solid journals. We are still waiting for the answers, and it's better not to cite the name of the journal. The rule, my rule, is to cite the name of the journal once we go for revision. So, back to the main topic. To say, let us go for the estimation step. Several estimation families have been proposed in the literature, starting from Merton 74, the pioneering work of Merton 74. First of all, the proxy approach tries to combine accounting values and market values to come with a number for the firm's asset value and the start to evaluate debt securities. Of course, as I explained, this approach is not good at all because mainly the structural model is here to adjust accounting values. So if accounting values are here as input information, we are trapped. You understand? The second family tries to make the link and the parallel between the volatility parameters of the equity process and the volatility parameter of the firm's asset value process. And then put a value on this quantity and which results which makes the evaluation process feasible. But the restricted volatility approach is good. It's due to Vasicek, who lived very quickly the academia and started his own consulting company, which was bought by Standard & Poor's after that. So I guess that Vasicek is a rich man now, but we lost it in academia. However, his methodology is good, but however, it sticks to the log normal process, which is a very particular Markov process that verifies the martingale property. So it's not flexible, it's not general. And we have to look for something that is much more flexible than the KMV process, the KMV approach and the restricted volatility approach. Comes the maximum likelihood approach by Duan 94 and 2001 that we extend in this research piece. More precisely, Duan starts at 94, a paper that was well published in mathematical finance, expresses the likelihood function of theta if we assume a log normal process and the Merton setting. Theta is made of two unknown parameters, a drift parameter and the diffusion parameter. But if we go and extend the setting, theta may be a vector of 5, 6, 7 unknown parameters to be estimated given the time series of the firm's asset value. In fact, the Markov chain of the firm's asset value. Of course, you see here a decomposition of the joint density function behind the likelihood expression using the fact that capital A, the firm's asset value, is Markov. Of course, in general, we prefer to work with log likelihood and not the likelihood function because this product is exchanged for a sum, and we are better for a sum, a large sum of small quantities than a large product of small quantities. The issue here is related to numerical analysis and the way we handle errors. Okay, so it's easy to write the likelihood expression, the log likelihood expression, and to optimize with respect to theta. The finance industry runs with that for 6 years, a complete 6 years, while everything here is incorrect, completely false, while the paper was extremely well published in mathematical finance. Thank you, Prof. Remier, my ex-colleague at HEC Montreal, who pointed out this issue for me from the very beginning. Yes, we tend to sometimes to forget even about fundamentals in statistics or in operational research, and to be in a research area in academia, we are always pushed to the right direction and to build good and nice constructions. Duan, I said why this is incorrect. Because the Markov chain of the firm's asset value is not directly observable. And keep in mind, please, this very important remark. The likelihood expression cannot be built on pseudo information. It is necessarily built on observed information. So we have to express the likelihood function of theta given the observables. And here the observables are not the Markov chain of the firm's asset value, but the Markov chain of the firm's equity value. So again, Duan in 2000, 6 years later, comes with a correction expressing the likelihood function given the observables from the stock market as a Markov chain, using some math here to switch this expression as a function of the pseudo observations, and the correction term is the derivative of the firm's equity value with respect to the pseudo observation at observation dates, time t equal to 1 to capital T. Time capital T here plays the role of the current date, today. Good. Now, how to extend Duan 2000 and to go for more complex models that cannot be solved in closed form and are approximated in some way here via stochastic dynamic programming. The idea is quite simple, is even very simple. When we cannot compute a function, here the likelihood expression or the log likelihood expression, we do as statisticians and as operational researchers, we put a hat on unknown quantities. And the hat here means SDP approximation, means the approximation via stochastic dynamic programming and finite elements of the firm's equity value, which is quite good. It's convergent, it's efficient, it's robust, it has almost all good properties we expect from an approximation. So now, again, we can compute the likelihood expression to be much more, to be fair. We have here a quasi-likelihood expression because we approximate this derivative function in some way. We can compute the likelihood function. We can compute the log quasi-likelihood function, and we can optimize with respect to theta given the observables. We use Nomad software package to achieve this optimization problem. And I'd like to thank Vivian and Christophe from GERAD for their big help in using Nomad and solving this optimization problem. Thank you again, my colleagues. To have a look on a particular quasi-likelihood expression under Merton assumptions, even under very simplified assumptions. We have a quite complex likelihood expression. As you see, we have possibly what is a global maxima. We have several local maxima and several local minima. They are not interesting for us. Hopefully, Nomad will drive us to this global maxima. I know it is difficult in complex and very complex models. We are happy if Nomad will bring us in local maxima that will play the role of the point estimates via maximum likelihood combined here with stochastic dynamic programming, because as you see, the quasi-likelihood expressions is an expression that combines likelihood, meaning the joint distribution function, density function of the observables, the Markov property, but stochastic dynamic programming approximation of this correction term given by Duan, which turned out to be true for more complex models. By the way, Duan did not provide these explicit expression for the likelihood function, but provides directly their counterpart in Merton setting that may explain why we stay in the dark for 6 years waiting for a correction, and we stay in the dark for 20 years, 21 years to extend Duan construction for more general and flexible structural models. Now, a case study, Pharma, the public chain of discount drugstores that went bankrupt in September 2001. Again, we assume very simple assumption, a log normal process for A with 2 parameters, the drift parameter and the diffusion parameter, a corporate tax rate of 35% because we take into account tax benefits. This is a minor extension. Bankruptcy cost parameter of 40% to say that we are taking into account here bankruptcy costs, which is a major extension of to Merton setting, and go to interpret the results. We go backward in time, and time zero for us is 1 year before bankruptcy, then 1.5 years before bankruptcy. You see what I am trying to do. I am trying to show that the model behaves well and becomes more severe in terms of credit risk indicators when we approach bankruptcy. Indeed, 1 year and 1.5 years before bankruptcy, the volatility parameter is quite stable, but the drift parameter, which indicates the tendency, the direction of the underlying state process, was minus 10% 1.5 years before bankruptcy, goes for minus 27% 1 year before bankruptcy. And this is a very good point because the model tends to recognize financial distress long time before its occurrence. That is a good point. That is a good point. Next, we go to compute main credit risk indicators. Here, yield spreads and total default probabilities at the horizon bankruptcy date. Again, 1 year before bankruptcy, 1.5 years before bankruptcy. And again, the model shows credit risk indicators which become much more severe when we approach bankruptcy. It's a very good and promising starting point for us, stating that with this model, we have accomplished probably a small step in the right direction. Now, some extensions to recompute the quasi-likelihood expression and to solve for that, not based on stock markets, because stock markets are not so sensitive to credit risk quality of a traded company, but based on other financial markets known to be much more sensitive to credit quality of the traded company. Examples include equity options and CDS contracts. We have mainly trustful information coming from these markets, and with little work on the way the structural model works, meaning how it is estimated and how it is evaluated and resolved, we can adjust and come with a new, completely new way to estimate the structural, complex structural models that probably will be well seen by the financial industry. With that, I come to an end to my talk. I thank the audience very much